How come crucial pricing parameters are still trapped in legacy core banking systems, and why is that a problem for banks today? Even today, determining interest and charging fees is largely done on systems built in the 90s. That's like running today's digital banking world on VHS tapes. So how does this data become trapped in the first place, and why does this hurt banks so much? In the early zeros, call centers were the first ones to break data free from the mainframe or the legacy cores, where branch offices and their personnel were becoming too expensive. So data was copied into the call center app, data about customers and accounts, so in-person dialogues could be handled even if the mainframe was offline. Soon after, in 2007, during the mobile app revolution, banks started to copy even more customer and account data into every new channel they introduced. At first, this worked. But while customers were expecting a seamless digital journey, let's say from a failed payment in the mobile app towards a discussion with a call center agent about this failed payment, the cracks began to show. Then came the early 10s, where regulators started to tighten the screws on banks. Policies like anti-money laundering, know your customer, and customer due diligence were introduced. Banks started to realize that having all these scattered copies of customers and accounts everywhere would maybe lead to non-compliance and thus massive fines. So they centralized data in a new layer in between the channels and the core. They built or bought CRM systems and attached their digital dossiers to it. And in that moment, the cores became slave to customer and account relationship data. At the same time, mainframe costs exploded while cheaper alternatives arrived. So banks started to hollow out their cores further. They carved out payments functionality, replaced it with modern, ISO-compliant payment engines. This saved expensive MIPS and core updates. It allowed for schema rotation from Visa to MasterCard or vice versa. And it opened up new revenue streams. In parallel, banks started to carve out billing functionality. And suddenly, they were able to introduce new value-based services without having to adjust the cores at a high cost. But interest rates are still largely trapped inside the old core bank systems. Why? That's because interest accrues against a daily closing balance. And balances are the most volatile data point in a bank. In today's mass micropayments world, it is nearly impossible to find a reliable moment to ship all those balances into another system for it to accrue interest accurately. And that is why interest is still close to the balances until today. Core modernization is not just about systems. It's about delivering trust to customers who expect a personal and instant experience. By freeing all pricing parameters from your core systems, the banks can meet those expectations and stay relevant in this digital economy. In this digital economy, where fintechs are gaining prominence, hyper-personalized pricing is key, combining favorable interest and fees to meet each customer's needs. Zafin fixes that. Our product catalog can master interest and fees, and we have connectors to most core systems, allowing adjusted interest rates to flow downstream. Our agreements and arrangement module captures every pricing plan for every customer, be that on negotiated terms or not. And because it's integrated out of the box, banks can avoid the heavy burden of IT projects and be compliant to regulators. The message here is simple. Stop letting your core dictate what you can and cannot offer. With Zafin, the cores no longer set the limits, your imagination does.